Hi everyone, I'm Jason with Level Up Investing, and it is Father's Day 2020, so happy Father's Day to all the dads out there. And today I'm going to go over something a little different. Normally I would do a video on an individual stock or an individual real estate deal, a very specific investment. Today it's going to be more general. In the volatile stock market that we have currently, there's a lot of opportunities to have your emotions go up and down. Feeling smart some days, feeling dumb other days, and believe me, I've felt all those in the past. So I wanted to just go over that today, calling this video "Feeling Smart or Dumb in the Stock Market." And the reason why I wanted to go over it is that maybe for some of the newer investors out there and who haven't gone through a lot of that, maybe this could be helpful, because I think if you could get a better handle of these emotions that come around when it comes to a volatile stock market, sometimes that might give you better control over the situation and over your investing. That's really what I'm thinking. So that's why I started this video specifically on this topic. So let's move into this chart, or this graph rather. So I have stock price up here and I have time on this axis here. And in the past 12 years or so, we have seen a stock market. Let me get my pointer here. We've seen the stock market before the beginning of this year really work its way up like this when it comes to the stock price, right? It's been a real bull market over the last 12 years or so. And so at any point at that time over the past 12 years, and I've done this myself, if I purchased right here and I'm looking back, it's retrospective, because hindsight is always 20/20. You hear that? It's always about hindsight that we get these emotions, I think, of feeling smart or feeling dumb about what we did. So if I bought right here and I saw it kept going up, and let's say it's a dividend bearing stock and I'm generating income through dividend and the appreciation of the value, or at least what I perceive to be the value, because the stock price is going up, then I'd say, hey, I was really smart when I did that. If I bought right here, I'd say, hey, I was really smart because it kept going up. And I can do that at any point here in retrospect. But then if there was a downturn or a correction, then when you get to that point, if I bought at that point, I would say, you know what, that wasn't such a smart move. That was a really dumb move, because look what happened to the market. Now, could I have foreseen that? No. But I would also always, say to myself, hey, look, I shouldn't have bought there, so that was dumb. Now, if I had sold at that point, I would have said, hey, you know what, I was really smart. So you can already see the idea of the different situations and a lot of the emotions that come up with investing in the stock market, as opposed to a stock market that is pretty stable. Then whether you buy or you sell, then the chances are with a stable stock market, then the feelings of being smart or not smart are much more stable as well. So especially if you're buying a dividend bearing stock. So and you're generating revenue throughout that whole course. So let's go into the situation that's much more relevant, more current, and that is when the stock market is much more volatile. So let's look at this graph here, and you can see what I've pre-drawn here is, I think you can see everything. Yep. So here is an example of a volatile market, and not unlike what we're seeing over the last several weeks here. So take these different situations, and let me change my color here of the pointer. There it is. So again, looking at retrospect, looking at looking in hindsight, right, and thinking back of what I should have done, what I shouldn't have done. For example, if the stock was at this point here, just before it went upwards, even in one day, went up 500, 600 points on the Dow, for example, and then your stock went up with it. So if I bought at this point, then I'd say, hey, you know what, I was really smart. Put an S right there, a little green S. I was really smart that I bought right there, because look, it went up afterwards. Now let's say a couple days later I decided, you know what, I sold at that point, and look what happened. the price went down. So I did really well. So if I sold, again, I was really smart at that point. Okay, let's take another example. Let's say we're not at the peak or the trough. Let's say we're in the middle, but in retrospect, again, we're seeing that the price had declined, and I happen to have sold at that price. Well, at that price, I could look back and say, you know what? Wow, I sold there, and then it kept going down. So I did the right thing. I got out when I needed to. So I was smart when I sold. Same thing here. Let's say it's on its way back up, and I happened to buy at the time, and it kept going up, which there's a lot of that fear of missing out, a lot of those emotions that come into play. And so if I bought at that time, hey, look, I was really smart because I bought, because it kept on going up. So if there was, and that would be like in a typical type of market, up and down, if there was a major event like what we've been having recently, or depending on what happened in 2000 or 2008 and all those times where we hit a recession. So if an event happens, and let's say a negative event happens, and then the stock comes down. Let's say I sold before that all came crashing down. Well, then at that event moment, I could say, hey, look, I was really smart there because I sold when I should have. If there was an event that occurred, let's say a positive event like a new technology came out, or if there's a company that really took off, the internet came around like 1997, like Amazon was coming out at that time. Let's say I bought then, I can say, wow, I was really smart when I bought then, right? So those are all examples of being smart in the stock market, at least feeling smart. That's probably a better way to put it. Feeling smart, like I did the right thing at all these points. So let's take the opposite side of that. Let's say at this point, before the market went up, I sold. And again, I've done all of these, okay, in the past. So I've learned a lot from all of these. So let's say I sold at that time. Let me get a different marker here. Let's say I sold at this point. Well, I sold and the price went up after I sold it. So I'm feeling really dumb about that, right? Let's say it went up here and is at the peak here, and looking back, I noticed that the price went down, but I bought at that time. You know, I bought at the peak. You've heard that before. Well, I would feel, hey, I was really dumb at that point, okay? If there was a major event, like a positive event, a new technology, and I happen to sell that stock when I feel like I shouldn't have, again, in retrospect, then okay, I was dumb to sell there. If that stock all of a sudden was on a decline, and in retrospect I say, wow, look at that, I bought it as it was going down, then I'd say, wow, that was dumb. As it's going up, let's say I sold it right there. Wow, you know what? I feel really dumb that I sold it because look, it went up after I sold it. Let's say there was a major event like a 9/11 or a pandemic or something like that, and stocks started to go down, take a big dip. Then if I happened to buy before that happened, okay, wow, I'm concerned that I was really dumb when I did that. So you see all these different examples of feeling smart or feeling dumb in the stock market. I have one more here, which is really interesting because this is more relevant to now, where companies are in bankruptcy. Let's say there was a major event, and all of a sudden, a company has filed bankruptcy. Think Hertz. That's a good example. But you have people out there buying. You have people buying stock, and you even have the company trying to sell more stock. So to me, that's a very unique, I think it's a very unique situation. And to me, that is one big question mark, 3 question marks there. And personally, that's not something that I would trade at all in any way if a company's already bankrupt. But it's interesting to see that some people are doing that. A lot of people are doing that. especially retail investors apparently. So the point of this chart, let's go back here. The point of this chart is to show that in a volatile market, there's plenty of opportunities to feel smart. There's plenty of opportunities to feel dumb. There's plenty of opportunities to feel like you missed out. There's plenty of opportunities to feel like you're the greatest investor and that you're greater than Warren Buffett. There's a lot of those opportunities, and again, I've experienced a lot of these, or all of these, at some point, except for that one at the end there. So my current strategy with stock investing is that I am trying to avoid a lot of this. I'm avoiding these ups and downs, and I'm taking a much more disciplined approach to investing. So what I'm doing is I'm looking at stocks, looking at the fundamentals, and you've seen this in some of my other videos. I look at the fundamentals of the company, the financial statements, and I'm looking to decide which companies I'm going to be investing in the long run, and then I'm deciding what's the price that I'm going to pay and what would be a reasonable discount for me. Now, normally I'll try to get a company at 50% discount, which that may not always happen, but you never know. But the whole idea is that I am determining which companies are excellent companies for me to invest in, which ones match my portfolio criteria, which companies I understand really well, and then I'm waiting to see what price it's getting to, so that it is below the intrinsic value that I've determined. So when you take this chart here, and if you look at stock price over time, let me do a different color here so you can see. Let's do a purple here. So what I'm doing here is I am waiting for the stock prices to drop so I am kind of hovering around here. So that is really my buy area, because what happens? I minimize a lot of these concerns that I've seen here and the volatility. And when I buy here, I feel smart there. And if there's an event and I buy, I feel smart there. So, and again, forget about that last one. So I maximize the chances of doing what I consider to be smart moves by doing this approach. So I hope that makes sense. And that's my new approach. I used to trade up in here, and I'm doing this a lot more. The majority of my buying is here. I'd say about 75% is what I'm doing here. The other 25% is more, well, 75% is more here, and 25% is more of growth companies that I'm very much interested in, the technology or some other aspect of the company that's making it very interesting to me, which I'll be doing videos on that soon. So here is a quote from Warren Buffett that was from 1966 when he was when he had owned Dow Chemical, and the company was decreasing in its stock price, and he got a whole lot of opinions about it. And he said, "We don't buy and sell stocks based upon what other people think the stock market is going to do. I never have an opinion, but rather upon what we think the company is going to do. The course of the stock market will determine to a great degree when we will be right," and that's the key word, when, "but the accuracy of our analysis of the company will largely determine whether we will be right." In other words, we tend to concentrate on what should happen, not when it should happen. So Warren Buffett really makes a point there, and again, this is back in 1966, and it's still the same today. He makes a point there that his focus is on the company itself, the analysis of the company, and determining when he's going to buy based on what the stock market has actually done. So anyway, here is a chart that I'm putting up for a company that's also one of the companies on my list. As I mentioned earlier, solid, long-standing companies, dividend-bearing companies that that can be at a discount at some point. So I'm watching those. So the Procter & Gamble company, PG, you can see in this chart how the stock price was pretty steady, and in mid-March, like most other stocks, had the dip, and then it came back up, and now it's hovering around the the high one teens, and I'm not buying at this time. My buy price is well below $100, which I'm going to go over in another video. But just to give you a real-life example of what I mean by avoiding all the ups and downs of the volatility and really focusing on the company and when I'm going to buy. So last part I want to show you here is the key trends in 2020, which has a lot to do with watching and waiting and seeing what happens to these companies' stock. So key trends in 2020, what we're seeing is that that because of the pandemic, because of what's happened with many businesses, the business activity has decreased. And because of that, we expect earnings to decrease, and we're all anxiously waiting for the Q2 results that are coming up soon here in the next month or two. Earnings decrease. Meanwhile, debt is going up. A lot of company debt is going up. A lot of personal debt going up, and unemployment, as we all know, is really going up. So what we're going to expect to see is that the defaults are going. In fact, it's already happening. Defaults are going up on loans, company loans, personal loans. Bankruptcies are going to be going up, and and with that, the Fed stimulus, the Fed injection of funds into the market, keeping the stocks up. That's going to continue to go up. And the other trend that I look at is the Buffett indicator, which is the total market cap compared to the GDP, and it's a snapshot of how overvalued the stock market is compared to the GDP. So those are the trends that I look at. As you can see, these are based on watching actual facts, actual numbers that are coming out, as opposed to people's forecasts. I can forecast this as much as anyone else, but I'm going to focus more on which companies that I'm interested in, and based on the trends, when those companies are available at a good price. So I hope this is good content for you. I hope you can get something out of this. If you like the content, definitely give a like to the video and subscribe and hit the notification bell for future videos. In the next few videos, I'm going to go more over individual stocks like I've done before, some of these blue chip companies, but also some companies that are maybe not on the radar of most people, but companies that have high potential, I think, for riding a positive event over the next decade. So I hope you liked the video, and I'll see you on the next one.